Welcome to Corporate Bridge Academy. In this training of private equity, we are first going to start with the theoretical concept so that you understand the nuts and bolts of private equity, and then we are going to move on to a more practical approach. That is, we are going to see how private equity modeling and valuation is carried out. That is a more calculation based and practical approach of private equity training. So first of all, let's start with the theoretical concepts. So starting with the definition of private equity. Okay, so let me just read this slide for you. Private equity is risk capital provided in a wide variety of situations, ranging from finance provided to business startups to the purchase of large, mature quoted companies and everything in between. Now, what did we just understand by reading this definition? I bet nothing. So this is exactly why this slide was made, because to let you know that we are not going to learn this course in this approach. Okay, we are not just going to simply learn the textbook definitions. We are going to get into details of each and every word and understand what is private equity in much detail. Okay, so let us start by this story to understand a private equity. Okay, now to start with private equity, let me just tell you that private equity has been contributing a lot to the world economy. So let's understand what is private equity. Now, the PE firms, that is private equity firms, they partner with investors. Okay, so who are the investors for private equity? These investors can be pension funds, they can be university endowments, or they can be charitable funds. These are only the three investors, but there are a lot other investors involved. So let us just consider three investors as of now. Now, these are the investors for private equity funds. Now, what is the goal of the private equity? Okay, the goal of the private equity fund is to improve companies. Okay, so they will buy a company, improve it day by over time. Okay, and then after some time, after few years, they'll sell the company. Okay, they'll sell the company for a profit. Now this profit is to generate good investment returns for the investors. So the investors that we talked about, the pension funds, endowments and charitable funds, these are the investors, and finally the PE fund will buy a company, improve it, then sell it and generate huge amount of returns, and they will distribute this returns amongst the investors. Now the PE firms, they will typically buy two types of companies. Okay, so let's start with analyzing these two types of companies. So first is the promising company. Okay, so this is a small company but a promising company and has a huge potential for growth. Okay, so it has a huge potential for growth and expansion. And the next type of company is this factory which is badly in need of repair and restructuring. Okay, so this is a struggling factory that we have and it is in need of repairs. Okay, so let's first start with this promising company. Now think of this company as an innovative software company. Okay, it has a bright future, but still it is relatively small compared to its competitors, and also it has a limited customer base. Okay, so it is in need of growth capital, the right strategy for its growth, and also experienced manager who can get it to the next level. Okay, so this is the first case that we have, a small company but has a potential for growth and expansion. This is the first type of company. Let us move to the second company that we have, the factory. Okay, now the company is in a bad shape. Okay, it is falling behind its competitors globally. So this is a small factory and it is falling behind its competitors and it is struggling. Let's see what are the reasons for those. Okay, so the main reason is the rising energy cost. Okay, this is the main reason for the problems with this small factory, but the matter of fact is that it has been providing quality products. Okay, this is a plus point for this company. The products are of really high quality. Okay, so it is processing quality products, but it is only lacking due to the limited capital in hand. So thus it needs change in the strategy and capital infusion for competing with the global competitors. Now let's see how will our innovative software company as well as this struggling factory, how are they going to turn around? The answer is with the help of private equity. So let us see how the private equity firm will help these two types of company individually. Okay, so starting with the software company. Now the private equity firm will provide the software company with growth capital. Okay, it will help it to make strategic investment and fuel its expansion. Thus, the software company can grow successfully and still maintain its bright future. Starting with the second type of factory that we have, the PE firm can also provide this factory with working capital for its investments. So it can expand itself, upgrade itself with other machinery and equipments, and again it can have a bright future as well. So this is how the PE firm will help these two types of companies and help get good amount of returns. Okay, the PE firm, what they will do is infuse some capital in these two companies. In return of this, the PE firm will get some amount of shares of these two companies. Okay, it will get some amount of shares. We'll look into details of this later on, but it will start infusing capital, make changes in the strategy, start improving these companies, and after a good amount of cash flows, after few years, the PE firm will finally sell the companies. This is one of the exit route. We'll get into details of the exit route in the later part of the theory, but it can sell this company after, let's say, 5 years. And suppose it has bought this company by infusing $100 million, it may be able to send it at the end of 5 years at, let's say, $500 million. So it has a profit of $400 million. So it is a huge amount of profit, just a theoretical hypothetical example, but again we'll look into the details of this in private equity modeling. So after selling this company, it will get huge amount of returns, and this is how the private equity works. So we have not just gone through a simple definition, we have understood the core of private equity. Let's move on with the other concepts in the next set of tutorials.